Adrija and Aditi for being on our roundtable with to discuss the aspect of women in family offices. Everybody thinks that it should be the man of the house who should lead the investments for their family and create wealth further from the wealth that they have generated from generations. But clearly, y'all are one of the change makers and are taking the generational wealth ahead through great allocations in newer asset classes. So I'm going to quickly ask you guys to introduce you to our audience, and then we'll take it from there, starting with you, Aditi.
Hello, so I'm Aditi Kothari Desai. I'm now fifth generation in my family
Wow.
business, and we're in the financial services area. I'm also vice chairperson of DSP Asset Managers, which is part of the DSP group, of which I am part of. And I also started several fintech businesses, and I have we have a lending business also. So just several things all together.
Yeah.
And a family office.
Interesting. Adrija?
Hi, I'm Adrija. Thank you, Radhika, for having me, by the way. I'm second gen. We have a real estate business, which is our prime business. Apart from the other businesses, we have an education business with schools in Bangalore. And we have an e-commerce vertical. Apart from that, then we started the family office about 5 years ago. And while it is a well diversified conglomerate in some sense, we're a very small family, just four of us. So yeah, it's been a very interesting journey about in the family office and in the investing space.
Wow, just four of y'all and leading the charge, huh?
So just four of us, yeah.
But let me start by asking you guys about how do you view how family office investments were made earlier back in those times and vis-a-vis now when y'all have so many startup options to allocate your money towards. The private market has expanded much more than how it was before. And what we saw was that 80% or more was given towards public markets. But now the focus is slightly changing, and y'all are wanting to be a part of more innovative businesses. So, Aditi, how are you viewing the private investments market, and what does your allocation there look like?
So actually, you're asking me the wrong person here because my entire business is public markets.
Entire business.
No. So the family office
Yeah.
will be different, but DSP Asset Managers is a public
Yeah.
securities business, right?
Yeah.
So we invest in fixed income traded securities, and we invest in equities that are traded
Yeah.
in the public markets. And we believe it's a super investment because of all the tax breaks the Indian government gives. For that, the vehicle itself is not taxed for every trade you do, and then again, tax is only eventually only when you want to redeem,
Yeah.
and that also it's only 12.5% now. So for equities, and so it makes it a very much easier way to invest and most tax efficient way to invest.
Yeah.
Plus, because of SEBI, the fees are very low. Really pushing the fees down. And the funds are doing. Look at the public markets in India. The funds are doing very well.
Yeah.
And we have a bit of a correction right now, which we'll come back to. But otherwise, the markets have been doing very well. Everyone's very bullish on India in the long run. Coming to privates, we have a 10% allocation max. This is in our family office. This is not counting our operational business, but for others, between funds and this is all at cost. So at funds and direct startup investments, 8-9% max. But so it's not like we don't do it, and I also feel it's important because it builds the ecosystem. It encourages entrepreneurs, and we need new businesses to come up in India. That's how India will grow.
Yeah.
Except for one fund, none of our funds have finished 10 years. So I can't definitively tell you is this been better or public's been better. Once we finish 10 years,
Yeah.
For a good number of funds over different vintages, will I be able to tell you that I was happier with my public, I was happier with my private.
And when is that happening?
These funds are only coming up now. Private's been sexy only for the last 6, 7, 8 years.
Correct.
So each one has to finish 10. So usually it's like an 7 plus 1 plus 1
Yeah,
or something,
yeah.
or 8 plus 1 plus 1. So say 10 years,
Mm.
say even if you invested in 2016,
Mm.
you still have 2 years to finish
Yeah.
your 10 years. That also, the one that finished 10 years, they've not fully liquidated.
Mm.
Because they'll have 2-3 other remaining companies to
Yeah.
liquidate, so IRR goes down the longer the fund
Correct.
remains. So I can't give you any definitive answers till we've completed enough 10-year funds.
Yeah. Yeah.
Actually 2 of them maybe have completed.
Got it. But I'll come to the public market investing side in a bit. But Adrija, you are investing in a lot of ventures, and you've created Sattva Ventures. That's your baby. So why don't you tell us a little bit about your thesis there and what are you looking at?
So when we look at investing in the family office, we only look at equities and nothing related to debt or fixed income, nothing of that sort, because our thesis is that the money is coming from the main business, which has an opportunity cost.
Mm.
So I have to deliver an alpha over and above that opportunity cost. So investing into, say, private or private and public domain, public will always remain my favorite. I think 75% of our portfolio is public, because surely because A, it's liquid,
Yeah.
and B, because of the taxation is a lot more liberal.
Mm.
While now private is catching up, and in the latest budget everything, the tax break is now equal in the unlisted and in the listed space, uh, once the company goes public or once you sell, depending on its short term or long term. But there are certain businesses, for example, when Nykaa went public or when Paytm went public, these are companies that weren't in the domain and now have become, and people have made a lot of money
Yeah.
in that domain. But I don't think it will be my entire portfolio in the long run. Right now it's about 25%. I see this skewing between 20 to 30%,
Yeah.
depending on how the market is. Like Aditi said, markets corrected recently, so
Yeah.
this number will always vary, while these investments will be at cost.
Mm.
And again, what Aditi mentioned is absolutely right, that some of these, even venture investments, take a very long time to fruition.
Yeah.
So you really don't know what is going to come out of it. While in 21-22, it looked like one investment is topping up the other and valuations are just going crazy. Some of those companies are still at that same valuation or even lower.
Yeah.
So I think till one gets an exit of these companies, and this can be anywhere depending from 7 to 8 years to even 10 years, it really depends on what IRRs we're making.
Yeah.
While the public market has been quite rewarding in the last 4 years, if you only look at the 4 years. So, and it gives the additional bonus of being liquid.
Yeah.
Right?
That's true.
So, but it's very cool to see the Indian entrepreneurship spirit. The kind of startups that we see in tier 2, tier 3 cities even didn't exist. Everyone is now seeing Shark Tank and wants to be on Shark Tank and wants to be an entrepreneur, which I think is a great way of India moving forward.
Right. But in terms of fund of funds investments, do you all look at that as well as an asset allocation? Would you come in as an LP in any of these emerging funds in India?
So fund of funds has very broad meaning. A fund of fund can be within a mutual fund of the same kind. I'll have debt and equity, and now there's actually favorable taxation for that. It can be an international fund, right? Because you're investing into another fund abroad. And that's how we invest in India many times. It's a fund of fund. So you get access to international markets without having the expertise sitting in India, on Indian soil. That is also fund of fund. And both the governments become a little more liberal with taxation there.
Yeah.
If you keep your money after this April, if you keep your money for 2 years, means if 2 years finishes after this April, your taxation becomes the 12.5% long term. So they've been really good. So have I invested in fund of fund? Yes, international exposure, which is actually not counted towards my LRS.
Okay.
Except what has happened is that there's a cap.
That's true.
on which has been sort of we've reached as an industry. That was a $7 billion cap. So unless people redeem, you won't have space to put more in that fund of funds.
Yeah.
So I haven't heard of any other fund of funds. If there were other fund of funds of privates or something, I'm not there. I won't be there because we have a full family office. We won't add one more layer of fees, in my view.
I would agree to
Yeah.
that. I think in India, when you can directly access funds, why would you, unless there's a consortium of
Yeah.
funds that are offered, especially from the international perspective. But in India, I don't think it makes
Yeah.
sense unless there are some funds that take a bulk amount just because they have an allocation to fill. For example, you're a $1 billion fund and you have 100 million allocated to one LP. And then that is then subdivided across various LPs.
Yeah.
Because you don't want to have too many LPs on your capital. That's the only reason that you would. But we haven't done any of that. We've directly, in India specifically, gone on subscribing to funds. And the VCC route, I think we've done some fund of funds. But only internationally.
Got it.
Nothing in India.
But in terms of the international exposure that you guys have tapped onto, which markets are you geographically seeing as the emerging ones in your fund of fund strategy where y'all have specifically allocated some money?
I think we are very skewed towards India, and I think the India growth story is very strong. But I think in diversification is only why one would step out of India. And that would only be about 5 to 10% of the portfolio, I would say, at tops.
Yeah.
Because our GDP is growing at a 7%, which is with inflation is even higher. So find me another economy which is growing at a similar rate. It's kind of difficult to beat.
Yeah.
Yeah.
But in that 5-10% allocation, which geographical areas have you looked at?
I think emerging markets are strong. So I mean, while everyone is against China, the way it has corrected over the last 2-3 years, there is a very big delta in terms of P multiples, what we're paying here for a company and what we're paying there for a company.
Yeah.
It is huge. Like there are companies that are available at 7-8x P multiple, which is unheard of India because we were talking about 50x P multiples, right? So it is, it's corrected a lot. So I don't know if it is bottomed out yet, but there is a very big story or there is a very big upside provided things start working out.
Yeah.
And with the whole stimulus package that was announced about a month ago, China I think is quite good, and it's a manufacturing hub that no one can ignore.
Yeah, that's true.
We're still quite far away. I think that is Japan is another economy that is connected. I have my own doubts on how this US election will pan out.
Yeah.
So I'm not going to comment on it. But yeah, I think some of these emerging economies, Vietnam, Philippines, the consumption stories in these economies are very strong.
Got it. We were just discussing about their asset allocation and we just started, so nothing that you've...
No. Whenever we talk about international investments and asset allocation. All right.
Yeah.
So I think in international investments, you have your LRS, which is personal. Then I have my personal investments in FOFs that I was talking about, and then you have, of course, the family office. We all believe in diversification, which is key, because you're not only diversifying your stocks but even your currencies, and the rupee has depreciated 3.5% on average for the last 25 years against the dollar. So straight away you're getting 3.5%. So now, then you start looking as where to invest. When you look at the MSCI World Index, US is like 58% of that. So, you have to allocate, it's actually maybe even more now, I don't know the latest, but over 50 for sure. Whereas in India, everyone has like 99% in their own country, if not 100. So I feel like it's just important to move away. It's called home bias. and to move away a little bit from Mumbai. So when we launched our US fund, I could say 2011, 2012, we were telling everyone America, America, and no one wanted to listen to us. And it's given very stable returns. Obviously, America's had an amazing run. Nasdaq's had an even better run, but this is just a more diversified US portfolio is important. So I've been bullish and invested for a while. So by investing abroad, you can invest in things where India doesn't have that much exposure in the public markets. For example, new energy. You can't make a folio of new energy stocks in India, right? Same with sort of biosciences or something more complicated, or even semiconductors. So you have to look outside your country if you want exposure. That said, the sectoral bets are as volatile, if not more, like the Indian sectoral bets. So having a diversified international exposure is not bad. I also like Japan and China is also very good. I'm always nervous, but that's when you have to invest. Because when it's really at the bottom like this and no one's investing and there's blood on the street, and when everyone's fearful is when you have to invest. And where Japan is concerned also, actually the Japanese market's done pretty well this year, but then the yen has fallen so much. So then, you have to look at that also a little bit from a currency point of view. But that's against the dollar. And the dollar's also risen constantly. If, the governments come in and they decide that they want to cut interest rates, but I don't think that has as much to do with the government as it has to do with the figures that come in. And the Fed thinks of cutting rates, everyone will follow. At this point, then the dollar will fall, and gold, which has already got a bit of an uptick, would get a better uptick. So again, the gold story in India, because gold is quoted in dollars, if you invest in gold, straight away 3.5% you're getting because of the depreciation. So these are all ways to think internationally about your investments.
Understood. But Benaifer, since we have you in the house, we'd love for you to give a short introduction to our audience about you and the Patni family office, the Ray investments that you're working at.
Thanks. So, I think being the CIO of the family office, we started it from scratch 12 years ago. Kind of built the teams, set up the processes, outlined everything that needs to be done, laid out the risk return frameworks, and then probably got the engine moving, because we actually took over. The family was already invested in certain things, so you had to undo a bit and redo a bit, and that took about a good 2-3 years to kind of align it to where we thought is appropriate for them. Having said that, it's been a fantastic journey. We've been doing a mix of international and domestic investments. Of course, since the company was encashed in India, a lot of it is in India. But we have diversified a bit as well. We're across public markets and private markets.
What's the allocation?
So we're about, broadly, if you would say about 10-12% in private, because I'm talking about cost basis. I don't look at MTMs at all, because till the money hits my bank, I don't count that valuation.
You just talking about
All
of us think the same.
So we are at the same. So I'm talking cost basis, we stay there. And we kind of try and make sure that we have a mix of a little mid-sized companies in private, and we've done good stuff in the early stage as well. So but that's just 10% of it. I mean, the whole 85% is where all the jugglery happens. And try to kind of get a compounding at mid-teens level. So we're not very aggressive investors, but we just compound year on year, every year. So if you see a 12-year return compounding, it'll fall in that range.
Got it. And how does your international exposure look like?
We have a mix of equity and bonds. So we do, currently the situation for bonds is far favorable. So we have moved a bit towards that as well. But I concur with what was discussed earlier. It's a mix of things. You have to see how the markets are evolving. Currency is a major risk. So we try and stick to USD. We really don't go too much into any other currency, because then you at least have $1 risk in your portfolio. And that's the way we operate.
And any specific geographical areas that y'all have heavily invested into outside of
mostly
India?
US. Mostly US only. We do have real estate portfolio in UK.
Understood. Got it. Yeah. Yeah, I was just going to cover the European region. Have you guys tapped onto that as well? Because that is upcoming now after the Southeast Asian and the US market. Europe is something which is really emerging in terms of the real estate asset class. So, have you guys looked at that as well? Or it's
But
not been
it's
on
too
your radar?
local to go deeper into something like that. Like which areas. I mean, right now, in fact, UK is not at its
Peak.
best,
Mm.
and Germany is in the dumps
Mm.
where the economy is concerned. So it's important to see where. You have some people always optimistic about Europe. You have some people who are always pessimistic. So I don't know. You have to literally go country by country. Everyone thinks of Europe as one, but
Oh, yeah.
now it is different.
Correct.
Greece is looking up for a change
Mm.
apparently. So it's all different.
Mm.
But no, I don't have. I mean, we have some. I would have euro denominated things
Mm.
in my LRS, but not necessarily or invested into Europe.
Mm.
I
Got
concur
it.
with what Aditi said. I think
Yeah.
maybe some of the stocks would be of euro denomination,
Mm.
like LVMH, which was
Yeah.
a couple of years ago.
Ah.
But other than that, no real estate exposure
Mm.
or no real exposure specifically into a asset class
Got
in
it.
the
Got it.
European region.
What made you tap onto the UK market?
So the family has, wants to live there over time. So we started
Oh.
building something there,
Ha.
and that's how kind of it kind of went about.
Yeah.
But having said that, I mean the portfolio is not really for a multiplier effect. It's
Yeah.
more for legacy transfers and things like
Mm.
that. So it's not really I would say a investment strategy.
Yeah.
It's more a legacy transfer strategy.
Got it. Good that you touched upon legacy because I was just coming to the next question on that. You said that you're fifth generation. So how did you decide that what kind of cultural legacy do you want to take it ahead as, and what kind of values will you bring forward in your investment thesis? Because of course, when the baton is passed on to the next generation, it's up to you. How do you want to take it ahead? So what was your thought process?
So I think the big thing here is that is because you have to just last. You if you're in a hurry, you'll crash and burn. And I don't think that's something that we can't do. We can't crash and burn. Okay, so how do you last? By being true to your values. By making sure that your customers, investors are always first. Um, by making sure your reputation, as my father always says, is more important than your bottom line. Doesn't mean you don't make money because then you won't last. So, but there can't be a race, and somewhere you have to curb your ego all the time, and doesn't mean you're complacent. So it's always a balance, and I think just the values of making sure that we always do everything for investors first is important, and we are biggest investors in our own funds. So, and my other test is if I launch something, can I look my friend in the eye and tell them to buy it? My closest friend. And if I can't, then I don't want to launch it just because of it'll add to a revenue or something, or give me a better revenue. But if I can't look, and would I do it? And so those questions are always constantly you have to ask yourself. And if you live by that, you do good. By your clients, you do good for yourself. You do good for the organization.
So when you joined your family business, which new products did you launch?
So actually, I started the whole international business back 20 years ago. And that was to get international investors to invest in India. And we had funds, and we have funds in Ireland, and we have offices that, to really talk to people about India, explain India to people, and have them invest in funds that we've put together especially for them. So I did that. So that was like a whole business as opposed to maybe a variety of products for non-Indians.
Yeah, but 20 years back you were seeing a lot of interest from outside to invest.
Yes,
in
remember it
India?
was 2005 to 7, our big heady days.
Yeah.
So we did. Also, we so that's, and then wherever the Indian domestic products are, we have a product team. I have a CEO,
Mm.
so it's whatever they feel. But of course, I'm on the committee, so I can say no
Mm.
if I feel that a product is not the right product. But they don't even propose that because the people we choose and the CEO has the same values
Yeah.
as I do. So that's a positive.
Mm.
But I started the digital division of the SP, and I also started a fintech company, which is related to my industry. So
Mm. What's it called?
Compound Express,
Got it. We'll check it out. And
but that's for the distributors in my industry,
mhm.
for them to get better software.
Yeah. And Adrija, what's been your continuation of legacy looking like? You said that y'all are just a family of four.
We're just
so-
a family of four, and my father's first gen,
Mm.
and we come from very humble
Mm.
beginnings. So he's always taught us, my brother and I, that there is no substitute for hard work.
Mm.
The harder you work, that is the benefit, and there is, you don't have. He When I joined the business, he said one thing: you never don't lie because you always have to remember it.
Mm.
The truth is never written. So you will always, if you're speaking the truth all the time, you don't have to even remember it because you're saying the same thing over
Yeah.
and over again.
Yeah.
And integrity is the most important thing that you're putting forward. So I think for the last 30 years while he was building Satya, we always believe in under promising and over delivering. And I think that's what has led to creating what Satya is today.
Yeah.
And because we never knew we never forgot where our roots were, because my dad he's been working since he was 15. He's now, he's gonna be 60 in a couple of years.
Mm.
So it's been a very, very touching journey because we hear it firsthand.
Yeah.
So we can never forget it.
Mm-hmm.
And I think just because of that, our value system, whether it's my mom, my brother, or me, is so strong that we're learning every single day.
Yeah.
And I think growth is a mission, but being true to ourselves is very important.
Yeah.
So I think, and he works with the same passion that he worked when he was 50.
Mm.
So it's like I think when you see that kind of passion, I think, and that kind of hard work, you can't go saying I'm not doing no shit.
Yeah.
I'm not doing anything. So I think that's what has been driving us as a family, and I think that's what got us here. Now let's see what.
Yeah, but you told me when we spoke for the first time that y'all are launching some hotel properties.
So yeah,
So you
I
could tell
started
us
the
about that.
hospitality sector. We have a couple of hotels in Calcutta, but we are building our first hotel in Bangalore. That's my baby project. It's a 50-acre Taj resort, and it's has a villa component which is going to be sold, in a 33-acre wedding resort and MICE resort. But I promise you, Radhika, that will be something that you'll not see.
Yeah.
Because it's the amount of toil that has gone into it, and the amount of effort it takes to build such a thing. I sometimes comment that it's not easy. I tell my dad as a joke, then I'll turn grey. But we're doing that. We're doing another hotel just outside Bangalore, and we're looking at a couple of hospitality projects, because I think my firm belief is that what India was and what India is today, and what people of our generation are, we believe in experiences and spending in experiences rather than spending on things solely. That things are there, but it's experiences also.
That's true. And what about you? Like, how is the Patni family office looking towards its investment going forward now?
So, I mean, it's ever evolving. That's simply put. 12 years since we haven't really stopped anywhere.
Yeah.
So, we continue to see newer things and then see if there's adaptability in what we are trying to do. Case in point, there was a time when I think it was 2018. When Mr. Ambani came on an AGM and just said that, I'm going to hand over 1,500 rupee smartphones to everybody. And that's how our strategy changed. I'm just giving you an example.
Yeah.
So we started looking for companies on the content investment side.
Mm.
In today's parlance, they're called generative AI, but in that time, it wasn't called that.
Yeah.
So we do have certain early stage companies in that context, right? On the media and content.
Got
side.
it.
So that's the way we look at things, the way they're evolving. What are the mass directional changes, the trends which are likely to catch it,
Yeah.
and we try and incorporate a flavor of that into the portfolios. So, I mean, if you were to look at maybe the pharma space today, for example, the CDMO space, I don't know whether you're aware of this term.
No, what is it called?
It's basically an outsourcing of pharma manufacturing.
Okay.
Right. So, what tends to happen is that what we had experience as Patni computers, where the services sector was catching up. First,
Yeah.
it was the hardware which we did, then the software which we did. That same outsourcing is now catching up in the pharma side, where India is likely to become very big.
Correct.
So we are looking at opportunities to play that particular segment. So those are the kind of ways we kind of navigate the path and see where we want to land. But we do try to keep it simple. So we don't over allocate. It's part of the percentage strategy, which works. You kind of know what allocation to do and
Yeah.
kind of look for opportunities within that.
Got it. But let's just zoom out and look at the last decade and talk about returns. Like, what kind of sectors or assets have given y'all the most returns in your portfolio? Maybe you can start with your allocation.
For me, it's public equities. Simple Indian public equities. Done
Yeah.
really well for me. And I would invest through mutual funds. So I can't tell you this stock, that stock. But yeah, I mean, a small cap mutual fund is, in the long run, has beaten everyone. I truly believe, I believe in mutual funds, not just because I'm in there, it's because I also see the way SEBI really is a big police on top of that and really make sure that everything is as fair can be for the investor. And I think even more than any other country in the world, the regulator here is amazing when it comes to mutual fund investments and being fair. So, and I've seen the returns because the costs are so low in India.
Yeah.
And the other thing is compounding. I can keep my money there for however long I want. It doesn't jabardasti come back to me where jabardasti need to pay tax on it. In the mutual fund vehicle, the way it's set up as a trust is they can trade as much as they want and not pay tax. So the money keeps compounding. And when I need it and my money keeps going, I only take out as much as I want. And the rest keeps compounding. In the private markets, the money comes to me even if I don't want it.
Yeah.
And I have to pay the tax on it.
Yeah.
And then everyone comes back because they want to take it back from you. But they should be taking it, not post, the post tax, because in mutual funds it just kind of goes on and on like a bit of a
Evergreen.
energizer bunny.
Yeah.
And I like that component of compounding. So it is my favorite asset class. I also like hybrid funds. Everyone thinks that I will do my own equity and fixed income allocation. But if you put in a hybrid fund, you get equity taxation. Plus, it keeps rebalancing itself without you having to pay tax. So if equities falls really low and this fund needs to have 70% equities, automatically it's buying equities. So when it's low, it's automatically buying. And if something becomes too expensive, it's automatically selling because you have to keep that balance. So as a result, you're getting, it's balancing on its own. You're not paying tax for the balancing. And you're getting all the mutual fund benefits, the equity. And there's something called even equity savings fund, which has even less equity and really protects you on the downside. The other thing in the downside, people should remember, from 100 rupees, when you go down to 50 rupees, so that's a 50% fall. But for 50 to go to 100, it's a 100% rise. So you have to protect your downside.
Yeah.
That's what I tell people. So having these sort of hybrid funds for me helps me to protect my downside.
Understood. And how is your return portfolio looking like?
I think she's absolutely bang on in terms of Indian equities has been the asset class. Within that, there have been certain stocks, and I think there have been certain sectors that have played out very well. Banking played out very well in the last 10 years. And I think that story is here to stay. And it's not going anywhere. Yes, there are ups and downs, but uh, IT has been very strong over the last 10 years. Healthcare has been strong over the last, pharmaceutical has been very strong over the last couple of years. Specifically, going forward, I think these trends may change. Real estate has been very strong over the last
Yeah.
3-4 years going, and I think now the ancillary industries that come with real estate, whether it's laminates, whether it is plies, whether it is cement, all of those will have to come because all these houses that are getting made, they will use these as raw products or raw material. And I think it's investing is in general not very hard if you just look around you and see
Yeah.
what is actually happening. And you look at Bombay's whole map has changed with this whole coastal road coming up, right? And if you think about it, say 2 years ago, we saw JK infra everywhere, and infrastructure is a very very strong tool.
Yeah.
So when I read Peter Lynch's book, he said that investing
It's
is
true.
not very hard. If you
Yeah.
just have to look around you and see what's happening. So yeah, some of the sectors have played out very well for us. I think going forward, these trends keep changing. But what I like about equities is that it is liquid, and what she said, or very beautifully put, that you can shave off a little bit. You can shave off a little bit when you want to,
Yeah.
and you can reallocate it, which is not possible in a private. I never thought about it that way. When you said it, I'm like, yeah, that's so true.
Yeah. But in real estate, what kind of returns have you seen since the
Very,
time
very-
your father started?
There's no kind. I don't think I can define it in IRR. I can define it in square footage, but I cannot define it in IRR. We started off with a 100,000 office building. Right now, our
Yeah.
portfolio is almost about 18 million square feet, um, which is a combination of residential, commercial, and we have data centers and warehouses getting added, hospitality getting added. But I don't think it's an IRR quantification to the main business because it's not possible to quantify
Yeah.
it, right? But yes, it has been a great 30-year journey.
Yeah.
I think, but it's not possible for me to quantify it.
But in real estate also, which sector are you seeing uptaking the most out of the ones you mentioned that you have allocated into?
We have like from the family office, I haven't allocated to any real estate because
Okay.
that is the main office. That is the main business. So from a diversification perspective,
Yeah.
I have steered off real estate because the bread and butter comes from there.
Correct.
The 90% of the portfolio is still in real estate. So I wouldn't allocate from my personal or from the family office per se.
Got it.
But we have one of our companies going public next year, which is a REIT.
Okay.
So that has been an asset class that has been quite a favorite and stable asset class over the last 5 years
Yeah.
since the first one came up.
Understood. And at Ray Investments, how is that different from Putney Family Office? I just wanted to know.
No, it's the same. I mean, we just called it Ray Investments as a company because that's the way it's registered.
Okay.
But it is the personal treasury of the Putney family.
Got it.
So that's the way it is. But as far as investments return and all are considering, versus the two ladies, I tend to have a little bit of a different approach.
Acha.
The thing is that tax is inevitable, right? Whoever pays it, we got to go with it, right? So we look at it from a disciplined angle. We have very clearly defined what return and risk to bear for a certain asset class. And irrespective of what tax it might command, because every budget you will have an over evolving tax situation, right? Something is 30% at some times and it will be 15% the next times and things like that. So what we try and do is we have a disciplined approach of profit booking above a certain percent, right? So you will do the math. You will see what tax as per that particular budget year comes to, and how much return were you expecting when you invested into that particular asset class, right? And when it hits that particular number, which is factored in for the tax as well,
Yeah.
you will start trimming it, right? So which would mean that in some context, what Aditi said is you're rebalancing it, but opportunistically we don't look at it as tax as a deterrent. Let me put it like that. The objective is to compound the wealth at a certain number, at a certain trajectory, right? So 12 years hence, when my principal looks back at what we delivered at Ray, whether they were good years or bad years or zero, most people have forgotten the zero return years because the markets have been so kind,
Yeah.
right? But there was a time when there were years, and I remember two distinct years out of these 12 years,
Which
where
ones?
neither debt or equity was making any gains.
Which years were these?
Not too far,
2022.
22.
Yeah, वो तो है.
Both were negative.
वो तो है.
Right? It was 0%. I think -1 or something like that,
Yeah,
if I
it was
remember
almost
correctly.
like
Right?
Yeah.
There was no return on equity. There was no return on debt.
Yeah.
There was
Because
nothing.
Yeah.
rates were rising
Yeah.
and equities were falling.
Yeah.
So I think the idea, at least for us, it lies in compounding. And if we are able to compound the wealth, and also I must tell you, when you book profits out of certain asset classes, the way we handle it is that we don't invest the profit in the same asset class. Okay? So the capital can go back to the same asset class if there is an opportunity in a certain sector or in a certain, like at the shorter end of the curve, a longer end of the curve, whatever that is. But the profit as a principal goes into a different asset class.
अच्छा.
Alright? Which takes away the underlying risk.
Correct.
Because you have done what you have.
Makes sense.
So discipline of profit booking and alternating the profit into an asset class which you believe might do well from there on. So it completely depends.
So I just have to say one thing where tax is concerned. Tax actually, I think, is important because it does take away from compounding. Because if you want to keep compounding and the tax comes in the between, that's where I feel, and even some people in my family office feels you have to inevitably pay tax. But the more you postpone your tax, the more you can compound that. And also only to take what I need. I don't need that money today. The other rule is that if we profit take, this is what I tell my family office, and this is my personal wealth, it's my rule, that if I profit take, I have to know where I'm putting the money. And I should be aware of the tax, because then that asset class has to make up for the tax that I
Correct.
paid
Yeah.
first. So you're coming in at a negative. So first you better make up your tax and then do better than the asset class that you were with anyway.
Correct.
Right? So it has to really do well because it has to make up for your tax and beat this after making up for the tax. So if you put them in a race, this poor guy is already at the below and he has to race against the guy that you took the money out. So taking into account all of this is not easy. And keeping an account is not easy. So therefore in my personal portfolio, so the way we're divided is everyone has their personal portfolio and then you have the family office. And by the way, even we're only two people, my sister and me. Okay. And my father. We're only actually three in the sense of family. My mother passed away very long ago. So it's really only three. And my sister and I do a lot of the family office thing now. So I invest in thoughts. So, but even she thinks differently than me. Like she's much more into private. So this is the other thing I tell people in a family office. Eventually, everyone has their own risk profile.
Yeah.
Okay, and your risk tolerance. And what people think is completely different. So each should actually make their own decisions eventually. Because otherwise, someone with a different risk profile is making your decisions.
Yeah.
I tell this in context of married couples. That don't let the woman let the man do everything, but I'm also saying this in context of a family office eventually.
Sure.
But in terms of the risking, how do you really decide how much risk to take? How much should you push to your limits and
see, all of
stick
us
to the
have a high
boundaries?
ability to take risk. Risk profiling comes ability and tolerance. Now ability for family offices is all the same really. For basic investments. Of course, investing 2,000 crores or 5,000 crores in some plot of land and all is a different thing.
Yeah.
But I think for basic investments, the risk profiling is the same. Now, you talk to a regular investor, it's very different because he has 5 dependents and his income is low and or he's very old, living off retirement money. Those abilities are low. Our ability is the same to take risk. Tolerance varies. And if my risk tolerance is low, like, oh my god, the market's gone down 20% and I start shivering and I want to take all my money out. And sometimes I say, no, I'm okay. I have incidents where I've advised people and they've all said, no, I'm totally fine. The market goes. Trust you, this, that. 1 year, 2022 comes up and they get so nervous that in 2023 February they take their money out, which is the worst time to take it.
Absolutely.
So you think you have the right tolerance, but actually you may not even have it. But it's so important to be fully, strong about knowing, be self-aware about your tolerance, and if you've said something, try to stick to it. Don't get too nervous about it. And if the market goes down, your risk tolerance is high. If you say I'm going to put more in, which is probably like in COVID. Who on 23rd March 2023 actually played poker and went all in? You know what I'm trying to say? Which is what we should have all done. Yeah. And so how do you say it? I don't know. And in March 2023, on that 23rd of March 2020, who actually pushed you and who had the guts to push you? Okay, which is the lowest that the market went. It's so easily said than done, and every I would say fund manager and every CEO there was saying put the money, and I remember there was like a sarcastic comment. They have nothing else to say than put the money. Arey, it's bloody boring, but it is the right thing to say, and that now you go back and say that was the right advice. The other thing, I read Howard Marks and he said, everyone's asking me, is this the time to put money? I can't tell you this is the time to put money, but it's a good time to put money. Right? There's never a the good time, but it can be a good time. And so these are little things that your risk tolerance and reflection will help you. And also the longer you stay in the market, the more you see it, the more you experience it, I feel your tolerance goes up.
That's true.
This is all post 2014, let me remind you. Right? This dialogue. But if you've been at it for 25 years, it plays out very differently. There are years of patches when there is nothing happening. And that patch can be just around the corner anywhere. So whilst I respect, from Aditi's point of view, she is a wealth owner and she can pull out as much as is required. But for, a general audience who naturally makes ends meet, kind of has some EMIs or something that they have to deal with, they really don't tend to think like that. And that's where I'm coming from. And which is why, just to, I would love to know what the ladies did. I'll tell you what we did in COVID. March, we didn't do anything, of course. We just saw where it went. But in June 2020, we took a call on auto sector and on metals, right? And we did. Sorry?
Basis what did you choose those sectors?
Everybody around the world felt that growth had slumped fully. Like nothing's coming back, everything's gone for a toss. Metals were at their rock bottom. Metals are the main raw material for auto, right? Commodities is battered. Simple. So we just took a call on auto and metals. And we rode it out. 6 months, 9 months, nothing happened. Suddenly, 18 months down, everything was, we are back to growth, and everybody's competing on growth numbers, and you're making hay. So what I'm trying to say is you can do that only when you encash some money.
Correct.
If you're fully invested at all points in time, you can't do that. Right?
You have to have some raw material. So therefore, again, asset allocation is important. So what did we do? We transferred from fixed income to equities, right? So at any point in time, that asset allocation of having your pot in fixed income and equities is both important.
Yeah.
And this is something that I tell people. We've always been conservative as a family office, a little more into fixed income
Yeah.
than the average family office because my entire business is equities.
Correct.
And I'm fully dependent on the market in that business of mine. So in the family office, we have to be a little more conservative.
Yeah.
So that's how we're thinking um, on those things.
How
yes.
did
And sorry, there are years where she said
yeah.
we've seen zero. There's been zero return for 6 years. You
6 years,
invested in the
exactly.
peak of 2000. It took till 2006 really to recover your money in many cases. 2005, 2006. So it also we tell people do STPs. We tell the salary to do SIPs because in that same 6 years the SIP still made 9%.
Yeah.
Right, because of the ups and downs you're investing. So it's very important on also how you invest the money, not just where, when, all of that, which is people ask me. So yeah,
Yeah,
those
yeah,
things
yeah.
are important.
You also started pretty much during the pandemic.
No, I mean, we had an equity portfolio
Yeah.
that was going on for years.
Mm.
But we did a lot of rejigging
Mm.
of the portfolio, which turned out very well during COVID. Because stocks were at the bottom. So at that time, it was a great time to buy.
Yeah.
But we had liquidated part of our portfolio
Mm.
before, so there was enough, dry powder available to invest. But in March, and then there is a free fall happening. How much ever you convince yourself that let's invest, you want to wait it out. You want to take a pause. You want to put the gas off to see what exactly is going to happen. Because we didn't know whether the world would come back to how things are as normal today in 2020. When we're staying at home and beating those, beating and lighting, we didn't know what was going to happen. But and there was a free fall happening in the market. There was not a soul on the road, and how do you expect to come back to this, right? And then, so that was inevitable. But I think when things started easing out, that 40-day or that the first vaccine news came out, I think then there was a little bit of hope, and things had already bottomed.
Yeah.
So then we started picking up we picked up some banks at that time, we picked up metals at that time, and because we knew that this was a story that was here to stay. But the rejigging happened, which played a lot. I think it came out very well in hindsight.
Yeah.
But did I know it would turn out this way? I didn't know that.
Yeah. Nobody knew.
Yeah.
Yeah. But our audience is slightly more from the conventional backgrounds as well. So for them, I'd like to ask a general question as to where should people put their money in? Like somebody who's not too wealthy, not too poor as well, like a middle class family, where
It
should
really
they
depends
put?
on one's needs.
No, first you have to do your risk profile.
Yeah.
Okay, so you know your risk ability and tolerance at that point. And there are lots of tools out there. In fact, DSP, IM.com, if you go onto the site, they have Sarthi, which is a tool that helps you think through, what your asset allocation should be. You can do that and it'll tell you actually where to invest. It'll only be DSP funds because that's all you're allowed to advise on. The other thing which is important is I would really urge people to do SIPs because everyone's dependent on their salaries, and I can't tell you right now the market has bottomed because we're in a bit of a fall. It's better you do SIPs and you keep averaging out and getting the bottom of the market.
Yeah.
Do it once a month, do it once a week in times like this. You start putting the money. Third, there's something, a class of funds that are out called, so you don't want to do your risk profiling, chalo. It's called multi-asset allocation funds. So the one DSP actually has is got fixed income, international equities, domestic equities, and gold and silver. So you have commodities. So you get a bit of everything in there, right? And and we do the balancing for you. Again, there's no tax in the balancing, and so that's a good fund to start with if you don't want to think, right? Like for example, I know in my household, the staff comes to me and we're helping them. In fact, we have a video made on this, on what to do. And multi-asset is best for them because I can hardly explain risk profiling
Totally.
Yeah.
You know what I'm saying? So say multi-asset में डाल दो, SIP कर लो, you know, it's an easy thing. So it all, but doesn't mean the funds for them. I also have multi-asset. I was like that day, I didn't know what to do. I had some money there, put it in multi-asset. It's like a no-brainer for me also. Someone's doing the balancing for me. So it doesn't mean it doesn't have risks. It'll go up and down. It's just that you're protected with more of the diversification.
Yeah. Got it.
And I also think that liquidity is important because in that you don't know what you need. If you know what, like say for example, one wants to buy a house, one has to pay EMI. When the 100 rupees become 90 rupees now, then it's you don't know where that 10 rupees is going to come from.
Yeah.
So you cannot have अपनी startup में invest कर दिया and then that money is just stuck.
True.
Yeah.
And therefore, in fact, in that Sarthi tool, we first ask you how much money you're going to need for the next 2 years. That goes straight into liquid funds.
You need it.
Okay,
Correct.
and what are your EMIs? What are your obligations? We put all that together and it like spits out a number. So, I mean, it tells you.
Yeah.
Looking at all that.
It depends on also how many family members you have in the house. How many
Dependents.
how many dependents, how many generations are there. And even for family offices, in fact, that is important because the number of families needs that you have to cater to, whether it's a house, whether it's education, whether it's that's when you decide that this much money I will need only. And I can't afford to lose it at any point. It can compound, but it cannot, this is my zero level.
Yeah. You said one of your REITs is also getting listed now. So how good is it of an idea to invest into infrastructure asset classes which are
So
publicly
REIT is a
listed?
very safe asset class because there are multiple benefits. One, it's tax efficient. Two, there's a dividend income that comes to you every single quarter. And third, there is capital appreciation. Capital appreciation in two ways. One, the asset value increases or the property value increases, which in turn results in the stock price or per unit price increasing. Also, when say you left this office and this was not at mark to market rent because these were long leases, and now when it's put back into lease again, the NOI of that the NOI of the entire pot increases. So per unit, one gets a better outcome. So I think there is a very safe because it's not as volatile. Today, if it's 100 rupees, I wouldn't say like 6 months the other night it would be 150. But it would become 110, 120. But there is a regular cash outflow in terms of dividends. Because the NOI or that the rent that is getting paid is getting paid to a unit holder. So it's a very safe asset class in that sense. Because there is like regular flow of income that is coming, plus the upside of just like a stock of capital appreciation.
Yeah.
That is there. But I think it's very important to have your safety sorted out first. And then to look, like now futures and options are so common and everyone's doing futures and options.
Question is, what are they doing in
What-
futures?
But that's not investing, that's gambling.
Yeah.
But
It is
no,
fully gambling.
But then
It's not that, but and even if you want to do that, if your ability is very high, keep a pot and have some fun. But don't fool yourself that that's investing. That's your fun gambling pot.
Yeah.
that can be 5% of
Yeah.
your pot, but that cannot be 50% of
Yeah,
your pot.
yeah.
And there are people who
Or
are doing
100. I mean, when the ability is low,
yeah.
it's very risky.
Yeah.
So I think that is one that has to be very cognizant about those things.
Yeah.
So I'll just put it in a layman's parlance.
Yeah.
Is two things that you need to do right now if you're an investor and you have limited amount of capital is one, invest more of your PF money where you can contribute more to the EPFO because the EPFO does the needful.
An NPS.
And NPS. It gives you that 7-8% compounding that is required. You can draw a loan against it, so you have the fungibility. If you fall short, you will be able to meet your EMIs, etc.
Yeah.
That's one. And you can go higher than what the stipulated limit is. So you could do that. That eventually falls into the markets, it comes into the funds, comes into mutual funds, etc.
Yeah.
But it's not your pot of money to expend. Let's put it like that. The second thing is that if you are a home loan candidate, which generally I think a lot of people are in that affordable housing or maybe that kind of segment,
Yeah.
1 crore, 2 crore kind of houses, the first thing you need to do is go back and see whether your home loan is actually at a fixed or a flexible rate.
Mm.
You need to move it to a flexible rate because the interest rates are likely to move downward.
Yeah.
But more than that, you have to see which bank or which bank or which scheme is rebalancing it on a monthly basis,
Mm.
which most people don't tend to see. The rebalancing tends to happen once in 6 months, once in 3 months, and that way also, when you pay higher interest, you're losing your capital.
Mm.
So if you save your capital itself,
Yeah.
so for me the funda is very simple. Money saved is money earned,
Huh.
right? So if you manage to do that, then you have better disposable income.
Mm.
And from that disposable income, if you put that money in EPFO, you're likely to make more compounding effect
Yeah.
over the tenure that you work.
Huh.
It's as simple as that.
Yeah, makes sense.
Yeah.
Understood. But
Okay.
with that, I think we come to the end. I wanted to take a tour of your investments and what advice you have for people who are listening so that they could also invest and create wealth for themselves one day. But thanks a lot for your time. I know that you all are running short on time and y'all have given a lot of insights to our audience and to me personally. So thank you so much, Adrija, Aditi, and Benaifer for coming on the show.
Thank you.
Thanks. Thank you.
Thank you so much, Alex.